The greatest mistake a man can make in the stock market is not in being wrong, but in staying wrong. Yet there is a greater, more final mistake: to be right, to win the great pot, and then to lose it all. Making money in speculation is the easy part. Any bull market can convince a man of his own genius. The true test, the one that separates the speculator from the gambler, the survivor from the ghost, is keeping it. The market gives, but it is always waiting, patiently and without emotion, to take it all back the moment you lose your discipline. The game is not about accumulating a high score on paper. It is about converting that score into cash, into security, into a fortress of capital so strong that no single mistake, no bear market, no personal failing can ever send you back to zero. I learned this not from books, but from ruin. I made my first million before I was 30, and I lost it just as quickly. I made fortunes and lost them multiple times over. Each time the lesson was the same, etched deeper into my soul with the acid of regret. The market is an expensive school, and it charges a fortune for its education. The tuition is paid not in dollars, but in sleepless nights, in gut-wrenching anxiety, and in the cold, hard reality of starting over. A man must learn that he is his own worst enemy. The human impulses of hope, fear, and greed are not his allies. They are saboteurs hiding within his own mind, waiting for a moment of weakness or arrogance to seize control and steer his ship onto the rocks. Jesse Livermore consistently stressed that Wall Street extracts a heavy cost of instruction for every lesson learned the hard way. Fortunately, the core principles he developed to survive these expensive market penalties were captured for posterity by Edwin Lefebvre in the 1923 masterpiece, Reminiscences of a Stock Operator. It stands as the finest possible literary training ground, allowing you to absorb decades of painful operational experience without ever having to risk a dollar of your own capital. To ensure this timeless wisdom translates accurately to the modern, computerized arena, we advise seeking out the Max Davidson Annotated edition. Davidson's careful commentary is indispensable for bridging the gap between Livermore's era and ours. A link to this essential edition is provided in the description below. The principles I forged in the crucible of my own catastrophic errors are not theories. They are laws of survival. The most important of these do not concern how to make money, but how to preserve it once it is made. Here are the 6 unbreakable laws of wealth preservation. Ignore them at your peril. First, you must systematically withdraw your profits. A trading account is not a vault. It is a battlefield. Any money left on the field is at risk. Your profits are nothing but vapor, numbers on a screen, an opinion of the market, until you transfer them to the safety of your bank. In my early days in the bucket shops, the unregulated brokerage houses of their time, I learned to treat my winnings as real money. I would demand my profits in cash at the end of the day or the week. The physical weight of the bills in my pocket was a constant reminder that the game was real and the winnings were tangible. This habit saved me. When I graduated to the New York Stock Exchange, the sums became astronomical, but the principle remained the same. After a successful campaign in a stock like Union Pacific or Anaconda Copper, I had made a fortune. But in my youth and arrogance, I saw it only as more ammunition. I felt invincible, the boy plunger, and I left the money in my brokerage account ready for the next fight. Inevitably, my judgment would falter. I would overtrade, fight the trend, or grow impatient, and the market would mercilessly reclaim what I had won. My $50,000 profit would shrink to 10, then to nothing, then to debt. I learned, through the harshness of repeated failure, that the most important trade you make is the one where you move your winnings from your brokerage account to your personal bank account. This act does 2 things. It converts a paper profit into real, usable wealth. More importantly, it protects that wealth from your single greatest liability, your own emotional state after a big win. Euphoria is a more dangerous enemy than despair. It convinces you that you cannot lose, and that is precisely when you are most vulnerable. Therefore, this is the first law. Treat your trading operation as a business. A successful business pays its owner a salary. You must pay yourself. Set a rule. After every significant winning trade or at the end of every profitable month, withdraw a percentage of the gains, 25%, 50%, whatever the number, but make it a non-negotiable rule. That money is now off the table. It cannot be used to fund a reckless trade. It cannot be lost in a moment of hubris. It is yours. You have defeated the market not by winning, but by walking away from the table with your winnings. Second, you must convert a portion of this withdrawn wealth into foolproof safe assets. I mean foolproof specifically against yourself. After the panic of 1907, a crash I had anticipated and profited from immensely by being short the market, I was a wealthy man. But I had been wealthy before and had lost it. I knew my own nature. I loved the game, the thrill of the speculation, and I knew that if the money was available, I would eventually risk it. On the sound advice of a wise friend and against my own speculative instincts, I took $1 million, a staggering sum at the time, and placed it into annuities and trust funds. This money was locked away. I could not touch the principal. I could not use it as collateral for a margin account. It was, for all intents and purposes, gone from my speculative life. It was the single wisest financial decision I ever made. That money became my bedrock. In the years that followed, I made other fortunes and, yes, I lost them again. I went broke, completely and utterly. But the income from those trusts, the safety net I had built during a moment of clarity and discipline, was always there. It provided for my family. It allowed me to live without desperation. And critically, it provided the seed capital for my next comeback. A speculator cannot operate from a place of fear. He cannot be worried about where his next meal is coming from. By placing that money in annuities, I was not just buying an income stream. I was buying my own peace of mind. I was protecting my future self from my present self. This is the second law. Your goal is to use the engine of speculation to build a fortress of security. As you withdraw profits, you must allocate a portion to assets that are deliberately illiquid and boring. Bonds, annuities, real estate that you do not intend to flip. These assets are not meant to make you rich. They are meant to keep you rich. They are the firewall between your speculative capital and your permanent capital. You build this wall brick by brick with the profits from your successful campaigns, and one day you will find it is the only thing standing between you and the abyss. Third, you must never, under any circumstances, risk your lifestyle money. There must be a complete and total separation between the capital you use for speculation and the capital that underpins your life. The money that pays for your home, your children's education, your family's security, that money has no place in a margin account. To risk it is not speculation, it is a crime against your own household. When you trade with scared money, you are guaranteed to lose. Every tick against you on the tape, what you would call your real-time price feed, will feel like a physical blow. You will make decisions based on fear, not on the cold, hard facts of the market. You will sell your winners too early, desperate to lock in a small profit to relieve the pressure. You will hold your losers far too long, paralyzed by the hope that the market will turn and save you from having to realize a loss that means you cannot pay a critical bill. Hope is the speculator's worst enemy. It is a liar that whispers comforting falsehoods while your account drains away. I have been in debt for millions of dollars. I have known what it is to be unable to meet my obligations. That pressure clouds the mind like nothing else. It turns a clear-headed analyst into a frantic gambler. A man in that position is not trading the market. He is begging the market for salvation, and the market grants no such prayers. This is the third law. Before you ever place a trade, you must define your capital. Designate your speculative stake. This is your war chest. It must be an amount of money that you can lose in its entirety without it having any material impact on your daily life. If the thought of losing it makes you break out in a cold sweat, then it is too much. Reduce your size until you can accept the risk with equanimity. Only then can you make decisions based on your rules and your reading of the tape, rather than on the desperate pleadings of your own financial anxieties. Trading is a game of mental capital first, and financial capital second. Do not destroy the former by mismanaging the latter. Fourth, you must know when to stop. This is perhaps the most difficult discipline of all, for it fights against the very instincts that drive a speculator. It means stopping when you are winning and stopping when you are losing. It means stopping when the market itself is going nowhere. After a great triumph, when you have captured the heart of a big move and your account is swelled, the temptation is to immediately seek out the next conquest. You feel omniscient. Your confidence is at its peak. This is the most dangerous moment in your trading career. Your judgment is compromised by arrogance. You start to see patterns that are not there. You take risks you would never normally consider. You abandon the very rules that led to your success because you now believe you are the exception to them. The market loves to humble a victor. I learned to force myself away from the ticker after a big score. I would travel, go fishing, spend weeks or even months away from Wall Street, allowing the intoxicating fumes of success to dissipate. I needed to return to a state of mental equilibrium, of humility before I could trust my own judgment again. The same applies after a series of painful losses. The desire for revenge, the urge to win it back, is a powerful and destructive force. It leads to overtrading, to taking subpar setups, to doubling down on bad positions. The market does not care that it owes you. Trying to force a profit from an unwilling market is like trying to command the tides. You will only be exhausted and broken. This is the fourth law. Recognize the state of your own mind and the state of the market. If you are emotional, stop. If you have had a big win, stop. If you have suffered a bad loss, stop. If the market is choppy, volatile, and without a clear trend, what I called a market where the line of least resistance is not defined, then your job is not to trade. Your job is to go to the beach. Cash is a position, and often it is the most profitable one. The market will be there tomorrow. The critical question is, will you? Preservation of your mental and financial capital through strategic inaction is the hallmark of a professional. Fifth, you must remain pathologically humble. The market is a vast, impersonal force, greater than any individual, any institution, any government. It is the collective expression of the greed and fear of millions of people. To believe that you can impose your will upon it, or that your opinion matters in the slightest, is the height of folly. Your opinion is worthless. My opinion is worthless. The only thing that has any value is the judgment of the market itself, expressed through the price action on the tape. I saw a brilliant man, Percy Thomas, a legend in the cotton market, destroy himself because he could not separate his opinion from the facts. He had formed the belief that cotton was going higher. He bought and bought and bought. As the price fell, he did not question his premise. He questioned the market's sanity. He insisted the tape was wrong, and he was right. He held on, adding to his position, convinced that the market would eventually see the wisdom of his view. But the tape is never wrong. Percy Thomas went broke. He lost his entire fortune and that of his friends because he allowed his ego to write checks his margin account could not cash. He could not admit he was wrong. A speculator must be able to do this instantly, without emotion. A loss is not a personal failure. It is a business expense. It is the cost of gathering information. The moment a trade goes against me and violates my stop, my opinion ceases to exist. I am out. The position is closed. I can always re-enter later if conditions change, but I will not sit in a losing position and argue with the inevitable. This is the fifth law. Annihilate your ego. You are not in the business of being right. You are in the business of making money. These are two completely different things. You will be wrong often. The professional survives not by being right more often than he is wrong, but by ensuring his winning trades are exponentially larger than his losing trades. This is only possible if you cut your losses without hesitation the moment the market tells you that your initial judgment was incorrect. Be a servant to the tape, not a master of your own opinion. Sixth, and finally, you must diversify your life outside of the market. The speculator's craft requires intense, focused concentration. To make your fortune, you may need to put all your eggs in one basket and watch that basket with the ferocity of a hawk. That is how great wealth is built. But it is not how it is kept. Once the wealth is generated, it must be moved out of that single, volatile basket. The stock market is your factory for creating capital. It is not the warehouse where you should store it. I learned this lesson by observing the wreckage of men who lived and breathed Wall Street and nothing else. Their entire net worth, their sense of self, their happiness, it was all tied to the daily fluctuations of the ticker. A bad day in the market was a bad day in their life. A bear market was a personal catastrophe. This is no way to live. Your ultimate goal should be to use the market as a tool to achieve financial independence, which is the freedom to not have to care about the market's daily gyrations. This is the culmination of all the previous rules. You withdraw your profits. You place them in safe, foolproof assets. You build a life that is not dependent on your next trade. This is the sixth law. Your trading account should represent a decreasing percentage of your total net worth over time. As your wealth grows, you should be actively moving it into real estate, into sound businesses, into bonds and other instruments that provide security and peace of mind. Your aim is to transition from being a full-time speculator to being a full-time wealthy individual whose assets happen to include a professionally managed speculative portfolio. The market should be your employee, not your master. If your entire fortune lives inside your brokerage account, you are one bad decision, one flash crash, one black swan event away from destitution. Do not allow that to happen. Use the fire of speculation to forge your fortune, but do not live your life inside the furnace. These are the laws of preservation. They are not exciting. They do not promise quick riches or the thrill of the gamble. They are the sober, tedious, and essential rules of financial survival. They are the difference between a fleeting fortune and a lasting legacy. The market will grant you incredible opportunities, but it will test you every single day. It will test your discipline, your patience, your humility, and your courage. Win the battle against yourself, and the battle against the market will take care of itself. Protect your capital, and your capital will protect you.